2021, record year for ETFs.
Yeah.
Explain us how that record got set and why.
Yeah, it's actually an amazing story. So ETFs are now 32 years old since the first ETF was launched. And if you go back to around the time that BlackRock bought BGI, there was just about $1 trillion in ETF assets in total. Now there's that much has happened in the course of a given year. And so when you go back to the reasons why, I think it's got a lot to do with convenience. It's just an easier way for many people to invest. And it's got a lot to do with choice. I mean, we now have something like 1,200 different ETFs around the world. And so it provides investors lots of different ways to access the investments they want, not just here in the US, but across Europe, across the world, because of the exchange-traded way in which it works.
So some of us think of it sort of like retail investors and institutional investors.
Yeah.
Do they invest differently? Do you see a different pattern when it's the retail investors investing in ETFs as opposed to the institutions?
Yeah, and there historically have been two big clients. And so across our ETF business, we have about 30 million investors within iShares, and then there's about another 90 million in our index capabilities outside of it. And our origins were as institutions, different institutions wanting access to international markets, wanting access to the bond market. The big driver of our growth has also been wealth advisors looking to build portfolios and having ETFs in components. And I think the big new news has been retail investors, so self-directed investors really coming into the marketplace in significant size, especially over the past year and a half during the pandemic. And I think that's been a new source of growth for us, particularly with millennial investors coming into the market in a way that they hadn't in years past.
That was going to be my question, actually. How much of this is demographic? How much of it is actually generational?
Well, some of it, like the existing investors that we have today, and one big part of the story as to what has driven the inflows, has been just more and more existing investors putting more of their money to work because they liked what they saw in some of the early exposures, and they just keep adding as they save more. But I think the new force, and why we're pretty optimistic that the 120 million investors that we have will be 200 million over the course of the next 5 years, is this millennial investor coming in. And just to give you one kind of number, even if we just look over the past, since 2020, 30 million more Americans have opened up investment accounts just in the past year or two. And that's more than have opened up investment accounts in the prior decade. And the average of those investors is a millennial, 32 years old. They're coming into the market for the first time. They're looking for something convenient. They're looking for a good deal. And many of them are turning more and more to ETFs.
And how much do they typically start out investing?
So it completely ranges. So if I give you an example from outside the United States, just to give you a sense of it, we have German investors investing in ETF savings plans, and they're putting about 150 euros a month. And so we're seeing investors start out with small amounts, in many cases even smaller than that. A third of the investors in the United States have less than $500 to start, but they're saving a little bit every single month. And while that won't drive gigantic flows this year or next year, if you take a 5-year horizon or a 10-year horizon, they could be as significant, as important as institutions are, as wealth advisors are, as any other demographic segment is for us.
How active in general are these self-directed investors? Because some people have speculated that the retail investor is more likely to get in and out of various stocks and various indexes, ETFs and indexes over time. Is that true? Do you see them to be more volatile?
Yeah, I've seen, if you think about the 30 million new people who've opened up accounts just in the United States, I mean, there are a lot of differences amongst 30 million people, but at least as we look at the numbers, and there's been a lot of discussion, a lot of excitement, particularly earlier this year, about meme stocks and just the impact of retail investors on that. But when you look at the broader lens, 2/3 of all retail trading volume in the United States is going into ETFs. And that's a somewhat more, it's a less exciting story. Certainly it's exciting for me. It may be less exciting kind of on a day-to-day basis. But what's really driving it is methodical day-to-day investment behavior. Most of this is purchases. So it's mostly people putting small amounts of money into the marketplace. It could be in equities, it could be in bonds, it could be in some combination of those. But they're looking to it for its simplicity or for its ease or for its low cost or for things that have driven index investing for 50 years since the first index capability was introduced.
So I'm just assuming you've taken the friction costs down. And by that, I mean things like going into some paneled office and meeting some stockbroker and filling out a lot of forms. And for that matter, paying a fair amount of fees.
Yeah, well, the great thing is fee-based advisors are a really important constituent for iShares. And what we found over the years, and this is true in the United States, it's true outside of the United States, that advisors embrace more of a fiduciary mindset. They use more ETFs. And that's great because ETFs, we think, are a very important building block of a well-constructed portfolio. And so they're a really important segment. But when you think about a first-time investor, and particularly a first-time millennial investor, they're often getting into the market through self-directed platforms or through online platforms. And that's just a different way of engaging. And one of the things that's been a real boost, if you will, to ETFs is if you go back 3 years ago, most online platforms charged a commission to trade iShares. Now today, virtually all of them enable people to do that commission-free. That's in the United States and that's in Europe. And what that's done is that it's taken down the barriers to ETF adoption. And once those barriers come down and the friction is reduced, as you said, then you find more and more people using ETFs. And that's true if you're a wealth advisor and if you're focused purely on the client's fiduciary interest, you tend to use more ETFs. And if you're a self-directed platform and you take out the commissions, you tend to use more ETFs. And we think that's great for investors.
And you at BlackRock, as I understand, slice and dice this a lot of different ways. There are a lot of specialized ETFs.
Yeah.
Talk about specifically in the ESG area, environment, for example.
Yeah, and this has been a real change for us, particularly over the past 3 or 4 years. And it was catalyzed and sparked first by our CEO, who really started to understand and be quite vocal around climate risks as investment risks. And so with that lens, we started to understand the long-term consequences of thinking about risks from a fiduciary lens and thinking about the long-term risk and return dynamics. And then what we did within iShares is kind of based on that investment thesis, is we started to rapidly expand choice. So if you go back again 3 years ago, we had a couple of dozen ETFs that were ESG oriented. Today we've got 180. And what it allows clients to do is just more choice. And so a certain client may choose to screen out certain exposures or certain industries. Other clients may want to invest behind a lower carbon transition. And one of the things that I was particularly proud of this year is that when we launched our low carbon transition ETF, and it was an active ETF, it was the most successful ETF launch in US history, active or index. And so it just shows you the breadth of what the ETF wrapper can do. It can wrap ESG and market cap, it can wrap active and index. And if you're able to do something in a convenient way, in a low-cost way, in a transparent way, it turns out more investors want to turn to it. And we think that's good for the long term.
Salim, you described rapid growth, rapid expansion. They always taught me trees don't grow to the sky. Where's the sky for you?
Still a long ways away, because I think the remarkable part about the journey that we're on is that when you look at the ETFs as a percentage of our addressable market, we're at 3%. Slightly higher in the equity markets, slightly lower in the bond markets. But what it says to us is that there's a vast, vast opportunity to make bond investing more efficient by doing it through an ETF, to help clients find all sorts of new sources of return in the equity markets. And so there is still a long way to go. If in the scheme of kind of the financial markets in which we operate, we're a sapling, and we're still pretty small. Even though we've experienced pretty rapid growth over the past 10, 20 years.